Credit risk interview preparations for risk and counterparty teams. If you are preparing for credit risk roles in a bank or financial institution, this video is built exactly for you. We have created very comprehensive interview preparation material, specially designed for credit risk roles across banks, investment banks, and financial institutions, not surface-level theory. In this session, we go deep into how credit risk actually works in the real world, from credit analysis and ratings to PD, LGD, EAD, limits, collateral, derivative counterparty risk, IFRS 9/CECL, and stress testing. You will learn how interviewers expect you to explain credit decisions, risk trade-offs, portfolio behavior, and early warning signals, clearly, logically, and with confidence. Every question here reflects real credit risk interview scenarios, explained in a teacher-style, step-by-step manner, so you understand not just what to say, but why. Do watch this video till the end. This level of preparation can genuinely set you apart in credit risk interviews. Walk me through the primary responsibilities of a credit risk analyst in a financial institution. A credit risk analyst protects the bank from losses caused by borrower defaults. Your day begins with monitoring exposures, loans, derivatives, securities, and limits. You assess new credit requests, perform financial analysis, review business fundamentals, and assign internal ratings. You evaluate collateral quality, understand structural protections, and judge repayment capacity. You also track early warning indicators, review limit breaches, escalate concerns, and contribute to credit committees. Finally, you maintain documentation, memos, covenant reviews, risk dashboards. Your work ensures the bank takes risk consciously, not blindly. End. Explain the difference between probability of default, PD, loss given default, LGD, and exposure at default, EAD. Probability of default, PD, measures the chance that a borrower fails to meet obligations within a given period. It is usually expressed as an annual percentage. Loss given default, LGD, measures the percentage loss the bank expects if default occurs. It considers collateral value, seniority, and recovery. Exposure at default, EAD, measures how much the bank is exposed at the moment of default. For derivatives, EAD includes potential future exposure. Together, PD, LGD, and EAD form the core of expected loss calculations. How do you assess a borrower's creditworthiness using both quantitative and qualitative factors? Start with quantitative data: financial ratios, cash flow coverage, leverage, liquidity, profitability, and capital structure. Then, review qualitative factors: management quality, corporate governance, industry position, competitive threats, and strategic direction. Combine these with external perspectives, ratings, market signals, and peer comparisons. Finally, assess structural protections, covenants, collateral, and guarantees. Creditworthiness is never one number. It is a balanced view of data, behavior, and judgment. Describe how credit limits are set for corporates, banks, and sovereigns. Limits reflect the borrower's risk profile and the bank's appetite. For corporates, limits depend on financial strength, business stability, collateral, and industry outlook. For banks, limits consider capital ratios, liquidity, asset quality, and systemic importance. For sovereigns, limits depend on political stability, fiscal metrics, debt burden, and foreign exchange reserves. Limits are approved by credit committees and reviewed regularly to reflect changing conditions. A counterparty requests a higher trading limit. What analysis do you perform before approving or denying it? You begin with exposure modeling: current exposure, potential future exposure, and worst-case scenarios. Next, reassess credit fundamentals: financial performance, liquidity buffers, leverage, and debt maturity profiles. Review qualitative factors, management strength, regulatory environment, and industry trends. Check whether collateral, margining, or netting agreements mitigate risk. Finally, assess concentration risks. Is this counterparty already a large portion of the portfolio? You recommend approval only when risk is justified and well controlled. Explain how credit ratings, internal versus external, are derived and validated. External ratings come from agencies, S&P, Moody's, Fitch. They blend financial metrics, qualitative judgment, and industry assessments. Internal ratings are generated inside the bank using rating models. These models incorporate financial ratios, default history, industry risk, and qualitative scoring. Ratings must be validated regularly through backtesting comparison with default experience, benchmarking against peers. Internal ratings drive limits, pricing, and capital, so accuracy is essential. Walk me through how you perform financial spreading and ratio analysis for a corporate borrower. Financial spreading means transferring financial statement data into the bank's analysis templates. Once data is spread, you calculate key ratios: liquidity, current ratio, quick ratio; leverage, debt to equity, debt to EBITDA; coverage, interest coverage, cash flow coverage; profitability, margins and returns; efficiency. Asset turnover. You analyze multi-year trends and compare with industry averages. Ratio analysis turns raw numbers into insights about business stability and repayment capacity. How do macroeconomic conditions influence portfolio credit risk? Macroeconomic factors shift default probabilities. If GDP slows, consumer spending falls, or interest rates rise sharply, weak borrowers struggle first. Sectors like retail, construction, or small businesses may show early stress. High inflation reduces purchasing power. Commodity shocks affect input costs. Currency depreciation hurts borrowers with foreign currency debt. Credit risk increases when macro headwinds grow and decreases when economic fundamentals strengthen. You notice deterioration in a client's financial metrics. What actions do you take? Start with deeper analysis. Verify financial data and identify the drivers of deterioration. Next, speak with relationship managers to understand business context. Then, review covenants. Are any at risk of breach? If concerns escalate, consider limit reductions, increased collateral, tighter monitoring, update of internal rating, watch list classification. Early intervention protects the bank and gives clients a chance to respond proactively. Explain how credit VAR works and how it differs from market VAR. Credit VAR estimates potential losses from credit events: defaults, downgrades, credit spread volatility. Market VAR estimates losses from market movements: price, rate, FX, or volatility changes. Credit VAR is driven by PD, LGD, and correlations between counterparties. Market VAR is driven by historical volatilities and correlations of market prices. They serve different purposes, but both guide capital and risk limits. And describe how collateral, guarantees, and netting agreements reduce counterparty credit exposure. Collateral reduces exposure by providing assets the bank can claim in default. For example, cash margin or high-quality securities. Guarantees shift credit risk to a stronger party. For example, a parent company guarantee. Netting agreements allow exposures to offset each other, reducing the total amount owed after default. Together, these tools increase recovery, reduce LGD, and support higher limits. Walk me through the credit risk considerations for derivative products such as swaps, forwards, and options. Derivatives create two major types of risk: current exposure, the replacement cost if the counterparty defaults now; potential future exposure, how exposure may grow as markets move. You consider contract terms, duration, volatility, collateral agreements, netting, wrong-way risk, closeout rules. Derivatives can behave unpredictably, so modeling must be robust. End. A counterparty defaults. Explain the sequence of actions taken by the credit risk team. First, confirm the default event. Missed payment, bankruptcy filing, covenant breach, or failure to post collateral. Next, freeze limits and stop new trading. Then, calculate exposure at default, including any closeout amounts on derivatives. Work with legal, operations, and treasury to enforce collateral rights and guarantees. Finally, estimate recovery and update provisions while communicating results to management and regulators. Default management is coordinated, documented, and time-sensitive. Pause. Explain the concept of wrong-way risk, WWR, and provide an example. Wrong-way risk occurs when exposure to a counterparty increases at the same time the counterparty's credit quality deteriorates. Example: a bank enters an oil swap with an oil producer. If oil prices fall sharply, the bank's exposure increases because the swap is in the money. But the producer's credit quality weakens because lower oil prices hurt its revenue. This combination increases expected loss and requires extra controls. What is potential future exposure PFE, and how is it calculated for derivatives? Potential future exposure estimates the maximum expected exposure over a future horizon at a given confidence level. It is calculated using simulation or statistical models that project market movements and revalue trades. PFE depends on volatility, maturity, netting, collateral rules, correlation between market and credit factors. It helps determine limits and capital requirements. How do you assess credit risk for unlisted or privately held entities with limited financial information? You rely more on qualitative analysis and alternative data. You examine bank statements, management interviews, supplier references, industry conditions, cash flow proxies, tax filings, collateral quality, relationship history. You may also request guarantees or additional security. For private entities, transparency is low, so credit judgment becomes more important. End. Describe the differences between expected loss EL and unexpected loss UL. Expected loss EL is the average credit loss you anticipate based on PD, LGD, and EAD. It is predictable and reflected in pricing, reserves, and provisioning. Unexpected loss UL represents extreme losses beyond expectations. It drives capital requirements and stress testing. Banks price for EL, but hold capital for UL. Explain how IFRS 9 or CECL models classify assets into stages and measure expected credit losses. Under IFRS 9, Stage 1, Performing Assets, you measure 12-month expected credit loss. Stage 2, Significant Credit Deterioration, you measure lifetime expected credit loss. Stage 3, Credit Impaired Assets. Interest is recognized on net carrying value. Under CECL, U.S. GAAP uses lifetime expected loss from day one. Both frameworks incorporate forward-looking factors and macroeconomic scenarios. Walk me through a credit approval memo. What key components must it include? A strong memo includes executive summary, borrower description, financial analysis, industry assessment, qualitative factors, covenant structure, collateral and guarantees, exposure analysis, including PFE, rating recommendation, proposed limits, key risks and mitigants. The memo should tell a complete and transparent credit story. A client's credit spread widens significantly. How do you interpret and investigate the cause? A widening spread signals increased perceived credit risk. You investigate by checking market news, Earnings results, downgrades, liquidity tightening, sector-wide stress, changes in debt structure, equity price deterioration. Then compare spread movements against peers. If the widening is idiosyncratic, escalate and reassess internal ratings or limits. Market behavior often reveals problems before financial statements do. Explain how stress testing is applied to credit portfolios, including scenario design and result interpretation. Stress testing asks a simple question: what happens to our credit portfolio if the world becomes much worse than expected? You begin by designing scenarios. Some are macro scenarios: recession, high inflation, interest rate shocks, commodity crashes. Others are sector-specific: real estate downturn, retail collapse, supply chain disruption. Next, you apply the scenario to credit models. PD increases, LGD widens, recoveries fall, exposures rise. Finally, interpret results. Which borrowers default first? Which sectors create the largest losses? How does capital adequacy change? Stress tests uncover vulnerabilities before real crises appear. End. Describe the role of credit risk in structured finance products such as ABS and MBS. Asset-backed securities, ABS, and mortgage-backed securities, MBS, rely heavily on credit risk analysis. You assess the quality of the underlying assets: mortgages, auto loans, credit cards, borrower performance history, prepayment behavior, default and recovery patterns, macroeconomic sensitivity, structural features, tranching, credit enhancement, waterfall rules. Senior tranches have lower credit risk because junior tranches absorb losses first. Understanding structure is as important as understanding the borrowers. End. How do you assess concentration risk within a credit portfolio? Concentration risk arises when too much exposure sits in one area. You assess by grouping exposures by borrower, sector, geography, rating bucket, product type, country, counterparty group. You compare concentrations against internal limits and regulatory guidance. High concentrations can magnify losses in downturns, so they require monitoring and diversification plans. Walk me through the difference between counterparty credit risk, CCR, and issuer credit risk. Counterparty credit risk focuses on bilateral contracts, derivatives, repos, securities lending. Exposure changes with market movements and depends on netting and collateral. Issuer credit risk focuses on debt issued by corporates, banks, or sovereigns. Exposure equals the amount invested. CCR is dynamic and market sensitive. Issuer risk is more static and tied to long-term solvency. Both require different models and monitoring tools. Explain how the CSA, Credit Support Annex, impacts exposure and collateral calls. A CSA is part of a derivatives agreement defining how collateral is exchanged. It sets rules for thresholds, minimum transfer amounts, frequency of margin calls, eligible collateral types, haircuts. When exposure rises above the threshold, the counterparty must post collateral. This reduces EAD and lowers potential loss. A strong CSA greatly reduces counterparty risk. How do you evaluate credit risk for leveraged lending or high-yield borrowers? Start with cash flow durability. Can the borrower service debt even under stress? Check leverage metrics: debt to EBITDA and interest coverage. High-yield borrowers often have fragile coverage ratios. Review business fundamentals, competitive strength, pricing power, and industry volatility. Analyze debt structure, seniority, covenants, amortization schedule. Because losses are higher in this segment, you apply conservative assumptions and tight monitoring. End. A covenant breach is reported. What steps do you take as a credit risk analyst? First, verify the breach. Review the financial statements and covenant calculations. Next, assess severity, temporary or structural. Does the breach imply liquidity issues or operational problems? Discuss options with relationship managers. Waiver amendment, additional collateral, pricing increase, reduced limits, accelerated repayment. Document the breach and escalate to credit committees. Covenants protect lenders. Breaches must be handled carefully. Explain how exposure netting and margining work for OTC derivatives. Netting allows trades with the same counterparty to offset. If one trade is positive exposure and another negative, the combined exposure is smaller. Margining requires counterparties to post collateral as exposure changes. Variation margin covers daily MTM changes. Initial margin covers potential future exposure. Netting and margining significantly reduce credit risk, especially in volatile markets. Describe how ratings migration analysis is performed and why it matters. Ratings migration analysis tracks how borrowers move between rating grades over time. You analyze upgrade rates, downgrade rates, default rates, transition matrices. Why it matters. Migration patterns help forecast portfolio deterioration, set capital reserves, and validate rating models. If downgrades accelerate, credit risk is rising even before defaults occur. A sovereign borrower is under economic stress. How does this affect its credit risk assessment? Sovereigns are exposed to macro shocks more than corporates. You analyze fiscal deficit, debt to GDP, political stability, foreign exchange reserves, access to markets, inflation trends, sovereign spreads. Economic stress increases default risk, reduces investor confidence, widens credit spreads, and may trigger rating downgrades. Sovereign distress also spills into banks and corporates within that country. Explain the concept of expected positive exposure, EPE, and its use in derivative credit risk modeling. Expected positive exposure is the average projected exposure over time, considering only positive exposures. It smooths out volatility and gives a long-term measure of counterparty risk. EPE is used for regulatory capital, economic capital, pricing of credit valuation adjustments, CVA, limit setting. It helps quantify how exposure evolves through a derivative's life. Dash. How do you challenge or validate a front office credit proposal? Start by reviewing assumptions, revenue growth, cost structure, recovery value. Are they realistic? Validate financial projections against historical performance and industry benchmarks. Stress test the borrower under adverse scenarios. Check covenant strength and structural protections. If the proposal feels optimistic, recommend tighter terms, additional collateral, or declining the request. Your independence protects the bank. What risk indicators do you monitor daily for early signs of counterparty deterioration? Daily signals include share price drops, credit spread widening, rating watch announcements, missed margin calls, declines in liquidity or market capitalization. Negative news, lawsuits, regulatory actions, payment delays, covenant warnings. These indicators act as early alerts before formal default risk becomes obvious. Explain how credit risk interacts with market risk during periods of high volatility. During high volatility, exposures on derivatives often increase. As markets move, one side of a trade becomes in the money, raising counterparty exposure. At the same time, credit spreads widen. When spreads widen, the counterparty's credit quality appears weaker. This creates a feedback loop. Rising market exposure and rising credit risk at the same time. Understanding this interaction is crucial for portfolios with derivatives or structured trades. How do you assess and monitor credit risk for financial institutions or banks? Start with capital strength, Common Equity Tier 1 ratio, leverage ratio. Evaluate liquidity, LCR, NSFR, funding stability. Review asset quality, non-performing loans, exposures to risky sectors, market trading losses. Analyze profitability and income diversification. Consider systemic risk, interconnectedness, reliance on wholesale funding, regulatory environment. Banks can deteriorate quickly, so monitoring must be continuous. A borrower requests covenant amendments. What credit analysis do you perform? First, understand why the amendment is needed. Is it due to temporary stress or structural weakness? Recalculate covenant ratios under updated projections. Assess whether the borrower can meet revised terms safely. Review liquidity, cash flow stability, and refinancing risks. Recommend conditions, additional collateral, higher pricing, shorter tenor, or more reporting requirements. Amendments should strengthen, not weaken, the bank's position. Explain how securitization redistributes credit risk and the roles of tranching and credit enhancement. Securitization pools assets, mortgages, auto loans, credit cards, and slices risk into tranches. Senior tranches receive priority payments and suffer losses last. Junior tranches absorb first losses. Credit enhancement methods include over-collateralization, excess spread, reserve funds, subordination. This structure redistributes risk across investors with different risk appetites. End. Describe a time or hypothetical scenario when you identified a material credit risk and escalated it. Here is a clean hypothetical example. You notice a mid-sized corporate borrower's interest coverage drops from 3 times to 1.2 times. At the same time, its share price declines sharply, and suppliers report delayed payments. You escalate immediately to your manager and relationship team. Recommend reducing limits, increasing monitoring, and requesting updated financials. Your early escalation prevents larger exposures from building unchecked. How do you validate the assumptions and performance of credit risk models? Validation includes backtesting model predictions against actual defaults, sensitivity analysis on key inputs, benchmarking against external models, reviewing model governance and documentation, testing discriminative power. Does the model rank borrowers correctly? If weaknesses appear, you recommend recalibration, data improvements, or model replacement. Model risk is real and must be controlled. Walk me through how credit risk teams communicate portfolio insights and risk updates to senior management. Communication must be concise, data-driven, and actionable. You summarize portfolio health, emerging risks, rating migrations, concentration exposures, stress test results, problem accounts, watch list movements. Use simple charts and short commentary to highlight trends. Senior leaders want clarity. What is happening, why it matters, and what actions are recommended. See you all. Credit risk is not about avoiding risk. It is about understanding it, pricing it, and controlling it. This was a complete, end-to-end interview preparation guide created specifically for credit risk roles in banking and financial institutions. If you followed this entire video, you now understand how credit risk is assessed, how limits are set, how defaults are managed, and how portfolio risks are communicated to senior management. Rewatch key questions. Pause. And practice explaining them out loud, because structured thinking and sound judgment are exactly what interviewers look for in credit professionals. For more deep, role-specific interview preparation across credit risk, market risk, product control, and banking careers, stay connected. And once again, do watch, revise, and master this material.